Hello guys, welcome back to this channel. What we are going to learn today is we are going to try and answer the question, what is the difference between ICT concepts and the smart money concept, especially from a beginner's perspective, so that you can choose wisely. Now the first the thing I want you to know is that both ICT, or in other words the inner circle concepts, and the smart money concept are one of the commonly used trading strategies in the financial market, particularly in forex, stocks and other assets. They share some similarity, as both of them focus on understanding the behavior of institutional traders, or generally what we call the smart money or the big banks. And this concept try to identify high probability trading setups. So despite that, they could be having some differences, which you are going to see in this video. Now, what is the objective of this video? I will explain with example the similarity for each trading concept. I will explain with example the key differences also, and then I will explain which one is good for beginners, which one is beginner friendly, in other words. Now the comparison parameters between these two trading style is going to cover the trading concepts areas that they focus. Number two, we are going to cover the key elements of the trading concept. We are going to check their time-based emphasis, tools and techniques, and then we look at other parameters. So let's start with the inner circle. By the way, if you want to know the difference between ICT, SMC and support and resistance, check video just after this video. Check the video before this video, or just check in the channel, Google it, and search it, and then you are going to find it inside this channel, because I'd already done that. Now so ICT concepts, or generally the inner circle trading concept. So on the focus part, let's check these particular points before we dive into the detailed analysis. Now ICT focuses on institutional trading. So ICT concept generally were designed by a guy called Michael J. Huddleston, who emphasizes understanding the actions and intention of institutional traders. Now the concept involves recognizing patterns that reflect institutional order flow and market manipulation. Now what about the key elements or techniques? Now ICT uses concepts such as fair value gap, order block, mitigation blocks, breaker blocks, liquidity voids, sell side and buy side liquidity, and other, and market structure shift, and market structure shift. Now these elements will help you as an ICT trader to identify potential area of price reversal or manipulation based on institutional behavior. Now what about its time-based strategies? So ICT concepts often involve trading at specific times of the day when institutional traders are most active, and example of such is London Open, New York Open, and let's say the Asia Close and Frankfurt. Now this approach aims to align with the natural rhythm of institutional trading activity. Now what about price action and liquidity? Now a significant focus is on understanding price action in relation to liquidity pools. ICT concepts emphasize areas where liquidity is likely to be present, such as above or below significant highs or sessions. I will explain here. So generally they call it sell and buy side liquidities. So ICT traders use these areas to identify where to enter or exit the trade, as is detailed somewhere around here. Now, what about market manipulation? Market manipulation, especially the what is called AMD circle. ICT concepts highlight how institutions might manipulate price to induce retail traders into taking position that benefits the BFIs. So as an ICT trader, you need to recognize these manipulative moves helps to help you trade in according with the smart money traders. So as you can see here, so let me just go through this. So this diagram demonstrates key elements or key techniques that are applied in inner circle trading, and that is fair value gap, order blocks, market structure shift, liquidity pools or session liquidity, time-based trading, breaker blocks, total soup or total sweep, the Judas swing, manipulation, and then the silver bullet. Any ICT trader must use these ones in tandem with each other or independently in a way, but they'll still be using others to make other informed decision. So assuming that the market is on downtrend and then it hits a higher time frame POI, like let's say fair value gap. The market mostly they like using fair value gap. So the market hits fair value gap region, higher time frame, let's say higher time frame, fair value gap. Let's say this was fair value gap and not just necessarily the band. So they are expecting price to start shifting a little bit, so they wait for session to open. So a session opens here, this box here. I've coined it as a session. So this session will manipulate people into buying and selling at the same time using a range, especially if it is Asia or London session. So when Asia ranges like this, it builds up liquidity on both the highs or session liquidity and both the session low. So in that particular manner, they are terming it as accumulation of orders. And then when session open, Frankfurt open, for example, in London trades, Frankfurt open, the lows or the highs, one of them is raided. That move, that impulsive V move that always raid sessions, they refer to it as Judas swing. So it is Judas swing because it is betraying people, showing that big boys have stepped in and they want to sell the market. And then again, they aggressively see it market moving in the opposite direction, sweeping everything, what is called the total sweep or the total soup. So this could be 1 hour, this could be 15 minutes. So they shift somewhere here. For SMC traders will shift somewhere here. Those who trade inducement will shift to lower trading lower time frame, and then trade the same character, the same price distribution here, and then see a shift in character or a change in character or market structure shift. So this last sell candle before the buy that did not hold here, or in other words SMT, the ICT concept guys call it breaker block. So it will not hold prices, causing market structure shift, and then when price taps to it again, there is likely movement. So it is an inverse order block. Now in this movement you are seeing here, this is where most ICT traders get into the market, because it is one that has collected liquidity, has done manipulation, and then it is displacing heavily, leaving behind fair value gap, which is mostly their preferred entry, and the order block down below the fair value gap. So some will use OTE zones. It means they'll go to fib levels and then try and find out the 50% is somewhere here, the 61%. So they'll try and find out where to get in using optimum trade entries. So then the market will displace upward, moving, causing breaks of structures in that way, collecting their loading more orders as they move. Now this window here is usually referred to as the silver bullet window, especially if it is in kill zone times, which is basically from 30 minutes to about 2 hours of the session. You are likely to see that so-called silver bullet. You can research about it or check in my channel here. You are going to find an explanation of silver bullet. So this is basically how most ICT traders trade. So they can also be looking at another breaker block here, continuation, breaker block, continuation. So this is the principle under which they revolve. Some may call this particular move here AMD circle, which is called accumulation, manipulation, and then distribution or displacement. So this is the basic element that you need to know about ICT trading style, especially the 2022 model. So you need to know that. Now what about the SMC trading style? So this is also another trading style that is very much popular, and the one I prefer to use because of how versatile it is. So what about the focus on market structure? So SMC revolves around understanding the broader market structure, trends, and price action to identify trading opportunities. It emphasizes the importance of aligning trades with the overall trend or market bias. Now there are key elements to SMC. So SMC involves concepts like supply and demand zone, support and resistance level for liquidity zones, forex patterns like the wedge and trend lines for liquidity manipulation points, and identification of swing highs and swing lows for further liquidity and breaks of structure. The idea is to identify areas where smart money or the institutional investor is likely to enter and exit position, as I explained in this diagram. I will go deep into it. Now another thing that revolves around SMC is order flow. So SMC places a strong emphasis on understanding order flow, which refers to the dynamics of buying and selling pressure in the market. So this will help you as an SMC trader to predict where the price is likely to move based on the balance between supply and demand. What about using confirmation candlesticks? So most SMCs are like ICT traders who focuses more on session liquidity, that is Asian and London high and lows for liquidities, and market manipulation AMD circle. Most SMC traders often use candlestick patterns like pin bars, engulfing patterns, institutional funded candles or IFCs, and inducements or IDMs, or more specifically single candle order blocks. If you don't know that, all these concepts I'm mentioning here, they are in this channel covered in details and to the highest probability. So just search the one you like for, and then find a detailed explanation on a video like this of about 10 to 20 minutes explaining with the chart examples. So however, some SMC traders enter after lower time frame, change of characters, and retest to the supply and demand zones when they want to get a clearer entry. Now these patterns provide insight into institutional price action behaviors at key levels of the market, as demonstrated here in this particular rough sketch. So basically, smart money traders try to identify smart money footprints. So SMCs focuses on recognizing the footprints of smart money or the BFIs, banks, and big financial institutions through price action and market structure. By identifying areas where these large traders are likely to have placed their position, you as a retail trader, you can align your trades to match their own and gain that momentum moves, like this expulsive move over here. So basically, let us presume that we are having a downtrend where market is causing breaks of structures. So when market pulls back into the first pullback, which is usually not below below 50% of the move, we will have an IDM there, and it will not be change of character. So the market will tap on order flow or support zone, supply zone, and then it will rally downwards, causing break of structure. Now where these people are expecting the market to reverse, because they are concluding that this was a change of character, that zones is called an SMT, because this is a weak low and therefore should be raided. The market rates pulls, it can even cause reactions and then pull it back. Like in this case, if this was an SMT zone, you can see it gave reactions, it even purged or raided liquidity, and then immediately it flashed down. So when the market pulls back to it, this last buy, last sell, last buy before the sell, this area we will call it order flow. From this point, order flow, but I've just marked everything. But this last buy before the sell is what is referred to as order flow. And if you check on this other expansive leg, you will find high probability fair value gap, and on top of it you will find high probability order block, because it traded the highs of this one, picking liquidity. It means there were no more orders up here, so the market is highly likely to respect order block that is here, or fair value gap, and then push downward, causing another break of structure, then another IDM or complex pullback, and then we have a break of structure down here. So when market hits it again, it will react to, let's say, fair value gap or order flow or order block, and then cause a break of structure. Now if you check market to the left, you will find higher time frame POI, let's say order block or other parameters. So when it finds higher time frame point of interest, the market will try and change character. So the first one will be a break of structure, but if it changes character, we refer to as market structure shift, or just generally change of character. So this could be internal change of character, a signal that the market is about to reverse. So when it hits this overall one, it now confirms that market will not be moving downwards anymore. So you go down and find from the origin price leg, you will find another POI, let's say order block or fair value gap. So the market will tap on it, cause internal change of character or eye choke, then cause another break of structure. Now other SMC traders consider this as the first change of character, so don't type there that, oh, this is not break of structure, this is change of character. I understand, all of them work regardless. So this could be just a sweep to move this this high here to this high, that is change of highs, or change of shift in change of character zones. I understand that. So when now it pushes again, causing break of structure, that is when now we conclude that this is now confirmation that the market is going to pull upwards. So when the market taps again to another demand zone here, fair value gap, it will rally upward. Now it pulled back a little bit because of high momentum, reacted to this breaker block or whatever you want to call it, then it moves upward, causing another break of structure. So when it causes another break of structure like this, when it pulls back, especially if the break of structure was caused by a leg that did not move 50%, you are expecting the price to take it again and then tap on unmitigated zones, push upwards. Now if an area is supposed to be is presumed a change of character, it is always likely to be an SMT, so be wary of that. Not all SMTs are SMTs. Some hold and then pushing price in the desired direction. So not all the time SMTs are SMTs, but this is just a coined term for smart money traders. So basically, key techniques in supply and demand trading is in the smart money concept is supply and demand, order flow, order block, fair value gap, market structures, liquidity engineering zones like the trend lines here. These are all liquidity points that the market is going to take, these trend lines here, because people are loading orders in this order flow. So support and resistance, people will be seeing those areas and trying to short from them, yet the market has already changed the course. Break of structures, inducement zones or IDM, changes in character, like I explained here. And then SMC relies heavily on top-down analysis. So this could be 4 hours, but where they are picking entries like this point, this point, this point, this point, this point. All of these areas could be 15 minutes. If this is one day, this could be 1 hour or 4 hours. If this was 15 minutes, this could be 1 minute zone, 1 minute, 1 minute, 1 minute zone. So it all depends on a person's preferred time frames. By the way, if you want to learn how I trade SMC, you can check my Telegram group. The link is in the description. Like this one, we were trying to catch this AUD USD on 15 minutes time frame using order flow. As you can see, I've marked here. So this one should not be broken, and if broken, the market has changed. So it came about so it came, as you can see, it gives a small reaction and started moving forward. So that means that order flow has now shifted to this particular point. If this is taken, the market goes bearish. So we were monitoring it. So it moved upward nicely, maybe 1 to 1, and then it came back. Already our stop loss was already protected, and then when it came back, our stop loss was tapped here, and then I said that the market is going to buy. I also gave another signal for sell in Euro USD using order flow. This is order flow or entry order block, and as you can see, the AUD USD trade shifted bearish. So anybody who wanted to sell would have sold at this break of this candle, stop loss above here, and keep riding the market downwards. We also looked at another USD sell, USD card sell, which went to break even. So BE hit. Then the Euro USD trade manifested well because there was no order flow was obeyed. Change of character, tap into the order block, rally. So I was looking at another trade here. So if you want to learn how I trade, look at these very good moves which continued. By the way, it heavily continued. So we picked another opposite trade, because how I trade is that if a price hits that level, it must go in my direction, or if it reverses, then the move is equally the same, it will reverse. So there was this gold trade that I said if this low goes, we should be selling. So when I gave it out, I indicated there the dealing ranges, and then indicated areas of liquidity that should be purged. So when this low was purged, the market kept selling. If you want to learn how I trade, you can check that particular link in the description. Now, what is the difference between ICT and SMC trades? So there is where by the way, there is no big difference between ICT and SMC. So that is what I wanted to take note, that there is no big difference between the two, only that some elements are emphasized more than the other based on the type of trading strategy. Now the first parameter to check on the difference is foundation. Now let us look at ICT. ICT is rooted, we are here. ICT is rooted deeply in recognizing institutional order flow and potential market manipulation, while SMC is in most occasions is more focused on the broader market structure and the interaction between supply and demand. Now what about the tools and techniques? So ICT has a set of tools and concepts like the Judas swing, fair value gap, session timing, session liquidities, AMD cycle, silver bullet, buy side and sell side liquidities, liquidity purges and raids. They both tend to share the fair value gap, order blocks, imbalances. But specifically for the SMC, they utilize more of SMC. For the SMC communities, they utilize more trading tools and concepts like equal highs and lows from higher time frame, support and resistance zones, trend lines, candlestick patterns, wedges, heads and shoulders, and all these are aimed at finding liquidity points, unlike ICT traders. Now what about the approaches to time? For the ICT people, ICT often emphasize the importance of trading during specific time zones of the day, so that you can align with the institutional traders, like the first few hours of the session, maybe between 15 minutes to 2 hours of the session. However, for SMC traders, they don't emphasize a lot on time specifics, but you can also incorporate that by focusing more on the market conditions. Now, what about market manipulation and market structure? So for the ICT people, ICT has a strong focus on understanding market manipulation by large players like BFIs, while SMC traders are more focused on aligning with the overall higher time frame market structure. So basically, both ICT and SMC, they provide valuable framework for understanding the behavior of institutional traders and identifying high probability trading setups. For beginners, understanding this concept will provide you with insight into the dynamics of market beyond basic technical analysis of support and resistance, and just basically forex patterns. So that is what you need to know about these two kind of trading style.